Let me ask you something. When you hear the word investing, what is the first thing that comes to mind? Is it stock tips, market predictions, trying to figure out what's going to go up next? Because here is the truth that most people don't realize until much later. The people who do well at investing usually aren't the smartest in the room. They are not glued to charts all day. They are definitely not predicting the future. What actually separates successful investors from everyone else is habits. Today, I want to talk about top habits that genuinely matter for investing, especially if you are just starting out. Not hype, not shortcuts, just behaviors that quietly make a huge difference over time. Before we get into it, a quick important note. This video is for educational purposes only. I'm not giving financial advice or telling you what to buy or sell. What I am sharing are habits, ways of thinking and behaving that can help you approach investing more calmly and more confidently. Because investing isn't one-off decision, it's something you do again and again over the years, and the habits you build early on tend to shape everything that comes after. Let's start with the first and arguably the most important one. Think in years, not days. One of the biggest mistakes beginner investors make is watching their investments too closely. Checking prices every day, refreshing apps, reacting to every headline. And honestly, that's understandable. When money is involved, emotions kick in very quickly. But here is the problem. Short-term market movements are mostly noise. Prices move up and down constantly, often for reasons that have nothing to do with the underlying business. A powerful habit is training yourself to think in years and not in days or weeks. Instead of asking, why is this down today? You start asking, does this make sense over the long term? A useful mental shift is this. If you wouldn't feel comfortable holding something for several years, you probably shouldn't panic about its daily movement either. Zooming out doesn't remove risk, but it reduces unnecessary stress. Habit number 2, invest consistently, not perfectly. A lot of people believe successful investing is about perfect timing, waiting for the right moment, trying to buy at the bottom, trying to avoid every downturn. But in reality, most people who build wealth do something far less exciting. They are consistent. They build habit of investing regularly, regardless of how confident they feel in the moment. Because waiting for the perfect time often leads to no time at all. Markets rarely feel safe when prices are low, and they rarely feel scary when prices are high. Consistency removes the pressure of needing to be right. Instead of asking, is now the best possible moment? You simply show up again and again. And over time, that matters far more than perfection. Habit number 3, separate emotion from actions. This is a big one and a very human challenge. Fear and excitement are normal parts of investing. They never fully disappear. The habit isn't about eliminating emotion. It's about not letting emotion drive your decisions. When markets rise quickly, people feel confident, sometimes overconfident. When the market falls, the fear creeps in. The danger isn't the feeling. The danger is reacting impulsively. Strong investors build systems that help them pause. They give themselves time to think. They avoid making decisions in the moment of panic or excitement. A simple habit is this. If a decision feels urgent and emotional, it's usually a sign to slow down, not speed up. Habit number 4. Stay invested during bad news. Every investing journey includes uncomfortable periods. Economic slows down, recessions, market crashes, headlines predicting disaster. The habit that truly separates long-term investors from the short-term spectators is staying invested during uncertainty. That doesn't mean ignoring reality or pretending risk doesn't exist. It means understanding that volatility is part of the process. Historically, markets have gone through repeated downturns and recoveries. Selling during fear often locks in losses. Staying invested allows recovery to happen. A helpful reminder is this: Markets don't need confidence to recover, they need time. And patience is a habit you can build. Habit number 5, keep your approach simple. When you're new to investing, complex can feel reassuring, lots of strategies, lots of products, lots of opinions. But complexity often leads to confusion and eventually mistakes. A powerful habit is keeping your approach simple and understandable. If you can't explain your approach in plain language, it's probably too complicated for long-term consistency. Simplicity helps you stay disciplined. Avoid overtrading. Stick to your plan when emotions run high. The goal isn't to be clever, it's to be consistent. And simple systems are easier to stick with. Habit number 6. Focus on what you can control. One of the most calming habits in investing is learning what not to worry about. You can't control market returns, interest rate decisions, political events, short-term price movements, but you can control how much you invest, how often you invest, your cost and fees, your behavior during a volatility. Successful investors spend most of their energy on the second list. A useful habit is regularly asking yourself, is this something you can control? If the answer is no, stressing about it rarely helps. Habit number 7, keep learning but don't overdo it. Learning is important, especially early on, but there is a difference between learning and constantly changing direction. A healthy habit is slow, steady education. Reading, watching, listening, but always grounding new information in your own goals and time horizon. Chasing every new idea often leads to confusion, not clarity. The most successful investors usually follow a few principles and repeat them patiently. What this means for beginners. If you are just starting your investing journey, here is the reassuring part. You don't need a large portfolio, advanced knowledge in perfect decisions. You need patience, consistency, and emotional discipline. Habits matter more than the headlines, and behavior matters more than brilliance. Here is a simple way to think about it. Good investing habits don't guarantee success, but they dramatically reduce chances of big mistakes. And avoiding big mistakes is often more important than making brilliant moves. Here is the conclusion. Investing isn't about predicting the future. It's about building habits that work even when things feel uncertain. Focus less on trying to outsmart the market and more on building behaviors you can stick with for years. That's how investing works in real life. If this video helped you, give it a like. It really supports the channel. And if you are building your investing journey from scratch and want calm, beginner-friendly content, consider subscribing. I would love to know in the comments which investing habits do you find the hardest to stick to. Thanks for watching, and I will see you on the next one.